Hello, everybody. This is Doc again. Today, I want to take some time and talk about what I think of different commodity prices. But one of the most talked about commodity lately has been gold. And everybody has their own way of valuing gold and the what the price target for gold should be. And that's great. I'm not smart enough to know where the price of gold is going to go, but there are a few principles that I use for valuing any commodity. The first principle is Warren Buffett and Charlie Munger consider money or the amount of money as a commodity. So when the amount of any commodity increases, the value of that commodity goes down. And that's basically the monetarist's view of inflation as well, that inflation is essentially the reduction in purchasing power of money. So as the supply of money increases, we that's essentially that results in inflation. Your money can't buy enough, and that's why everything becomes expensive. And then things like gold, oil, copper, etc. These are also commodities, and the things that determine their price is demand and supply, and their price in a certain currency, especially if you view a currency as a commodity, would be the demand and supply of one relative to the other. So a very simple way of explaining that is how people look at charts of gold and copper, gold to copper ratio, gold to silver ratio, etc. But one of the ratios brings out a very uncomfortable truth. This is also a commodity ratio. This ratio is called the gold to total money supply ratio. Now, in in the past, perhaps the M2 money supply was probably a very good indicator of the money supply. It has its imperfections. A G7 or G20 M2 is also a very good measure because it measures the money supply in large economies. The total money supply M2 increase worldwide would perhaps be a very good indicator. The best one, I think, is the global liquidity indicator, which is Michael Howell's work. And although he's on YouTube a lot these days, it's very easy to confuse him as a YouTuber. But truly, what he is a very intellectual person who's done a lot of research on it and a lot of formative work on liquidity. I highly recommend his book. I have no financial relationships with him. I've never met him. I would love to one day, but this is a great book for anybody who wants to understand liquidity and what drives asset prices. So yes, one of the important ratios that people ignore is the ratio of two commodities, which is the total amount of money available and the total amount of, let's say, any commodity available. That could be gold to the US M2 ratio as well. And when you look at that ratio, you see these very range bound oscillations during most of the time. So the gold price relative to money supply can go up or down. And if I look down, I'm actually trying to look at my screen. And it basically signals that at certain points of the cycle that gold may be undervalued relative to the amount of money in circulation. And there are times when gold may be overvalued or richly valued compared to the amount of money there is. Sometimes the price of gold front runs this money printing, and a lot of people make that as an excuse. However, that does not explain past cycles. Gold bulls, and I think there's a role of gold. I'm not an ideologue on gold. I buy gold or gold equities at certain points of the cycle, and I sell them because I don't look at gold as an ideology. I look at it as a commodity. I look at money as a commodity as well. So when you look at the cycles, it's also important to understand that there are some range bound oscillations in the cycles, and then there are far from range oscillations in these cycles as well. And I think everybody should also know that there is a very high chance that this could be wrong, but this is just the way I look at things. Um, I like George Soros's work a lot on reflexivity. I'm not endorsing any of his social agenda, social programs, etc. But he was a student of the market. He did really well in the markets, and that track record is quantifiable with the Quantum Fund. Stan Druckenmiller took over the fund. He's done remarkably well as well. But when Soros talks about asset prices, especially in the markets, he talks about the conditions that normally prevail, and these are conditions called near equilibrium conditions. If we were to think about equilibrium, you can imagine equilibrium as a fair value line, which would be the fair value of any asset or a commodity. And a near equilibrium line would be the one sigma deviation or whichever standard deviation you want to like measure. So essentially, it's what we would call a near equilibrium condition is that an asset price stays in a range bound asset price. Sometimes conditions exist which cause the asset prices or human psychology or conditions of liquidity or geopolitical considerations to cause this near equilibrium condition, which may be stretching towards a far from equilibrium situation, and it pumps it up. And this is what we call the hockey stick or the final mania phase of any bubble. And if you look at the gold chart, that far from equilibrium condition can be observed very well in the last leg of the gold bull market. And that was a spectacular bull market. If you talk with any gold bulls from old times, they really talk about this bull market a lot. But we don't have a lot of observations. We have like a few cycles, as you can observe, because the gold price was pegged before the 70s, and that peg basically artificially kept the rate price of gold pretty low. But when the peg was broken, it trades more like a currency or a commodity. And these cycles are very well observable. Now, if you look at that cycle, so Soros talks about sometimes these cycles, as you can see with Nvidia and a lot of AI stocks as well. And in 2000s, you observed that with like the tech bubble, that there is some reality behind a bubble or a bubble psychology, and that can feed on itself and reflexively cause asset prices to increase or commodity prices to increase. And you can see it very well in the 80s, the late 70s and 80s, and the gold price, sort of going out of that range bound value to new highs. And this is not the gold price. This is essentially the price of gold divided by the money supply or USM2. So essentially, it adjusts for the amount of money, and you can call it like a monetary inflation adjusted gold price. And I could be wrong because there's many complexities and constructs in that. But this is sort of what I use to make decisions. Now, that far from equilibrium condition was a singular event. If you look at another far from equilibrium condition happened when the gold price went below its fair value and then went from below its bottom. And I have this little pen and I want to try using that because I got it and it's kind of fun. So this portion likely represents sorry, let me just try this out. This portion likely represents a far from equilibrium condition, and these are rare conditions. If you've read his book, he would talk about it as well. And then, like every bubble, the money supply kept increasing, and the price of gold kept decreasing, reaching the bottom of its fair value range. And then after that, it went into a far from equilibrium condition, and that's just a subjective call. I'm calling it far from equilibrium because it's below that range. And a lot of this is based on beliefs and biases, and I have a lot of my biases being reflected here. So that was basically 2000s was a very good time for anyone to buy gold. That was pretty cheap. Warren Buffett famously bought silver around this range because he believed in his industrial uses and he thought it was pretty cheap. But yeah, and he was right. And then after that, this tends to be a period where you could accumulate, but the public interest is very low. There are usually reasons causing far from equilibrium conditions. Here it was the reacceleration of inflation and the narrative going around like monetary debasement, which was taken too far. Well, it was true, but not that true. And of course, markets work and it corrected. And then this far from equilibrium condition may have been caused by outflow of money from monetary metals and other commodities into the tech bubble, which everybody was making money in, and it's hard to resist when you know your neighbor's making a lot of money. So this could have been a very nice time to accumulate gold, but nobody wants to buy it during these times because it becomes a pet rock or relic. That is precisely the time to buy things when nobody wants them. And there's a lot of commodities out there today that nobody wants to buy, like oil and gas, coal, nickel, etc. There's a few more which I don't want to name because I don't want competition in buying them right now. Lithium was also like in this phase about a year or so ago. I purchased some lithium equities and they did pretty well. It's still in a stealth bull market, but by the time most people start realizing it, it's usually like around this phase. And that's like picking pennies in front of the steamroller. That's pretty much what we're seeing here as well. It's like picking pennies in front of steamroller. However, this can be the time to accumulate. This is usually the time to sell. But what happens is people start buying and drive the prices up. But markets work, and things reverse. A lot of gold bucks were yelling at Soros when he called it a bubble and started selling. Guess what? He was right. They were wrong. And there's nothing against gold bugs. I completely understand the value of gold. I completely understand why it's an important part of any portfolio, but there are times to own gold and there are not. And actually, this may be a time to own gold. Now, we are at this juncture where usually it reverts, but we only have a few observations here where it's done that, like one, two, three, and then this is probably the fourth time we'll see that. But you have to realize that what could push it into like a far from equilibrium condition could be like inflow from AI investors who are harvesting gains. We're seeing losses in the AI trade. That's definitely a very similar condition to what existed in gold in the 80s. It's definitely a bubble, and there's going to be severe losses from that. But if a lot of capital could flow from that area to this undercapitalized area, then you could see like further increases in gold prices. If there's a war with Iran or something, that could also lead to like more safe haven demand. And with the ongoing narrative around the U.S. Treasuries and U.S. safe assets, it may people may elect to put some money towards gold, and that could also drive the price up. And people made a lot of money from crypto, and although like crypto has, I don't invest in crypto, I don't understand it, I have no opinion on it. But I mean, if somebody bought a coin for like $1,000 or $100 and they're selling it for 70,000, 50,000, $100,000, I'm sure they made quite a bit of money, and good for them. But if they might want to rotate their money somewhere, and if there's like a crypto winter as they're talking about, it could be a source of capital for this industry. Um, then if the AI bubble breaks, then you could also see reacceleration of gold price. That's was precisely what you see around here as well. And this is also the China super cycle starting. There can be many reasons for that, but that was also like a reason. There was a lot of money that was made and destroyed during the AI bubble. Not everyone lost money. The ones who didn't probably had a religious experience, and that led them to maybe allocate some money towards gold as well. Now, starting 2011, the Fed was printing money. They kept on doing QE, and all the people they want you to believe that because the Fed's printing money, the price of gold is going to go up. They're right in the long term. Yes, they are. But there's usually a lag time between that happening and people actually starting to put money in it. So although the longer term thesis behind gold is correct, but people saying that QE will directly result in gold price increases is incorrect. It does with a lag for sure. Now, we saw that happening here, that the money supply was increasing and the price of gold was going down. Everybody's scared when the price of a commodity or anything is going down. Usually it is becoming cheaper to own. So this would have been a time to accumulate. And or like when you started seeing that okay, there is acceleration in the price here, this could have been the time to buy as well if you don't want to lose time. But as it approached its, let's say, hypothetical fair value and exceeded it a lot, now this is the zone where pigs can get slaughtered, and maybe there may be a case where people might this might go into a far from equilibrium condition and people might make money. I don't like to play this game. I think there's better risk reward elsewhere. And gold has been more than helpful to me. So what am I looking at? Coal, metallurgical coal especially, rare earths, but there's only one or two companies that are worth looking at. The one I own is a Clara. It's actually selling pretty cheap right now. It may go down more, who knows? But uh, eventually the value is there. Buying vanadium, Largo especially, that's probably like 20 to 25% of my net worth is invested in Largo currently. So that's also, you see a very clear pattern of hate there. There's another commodity that I'm actively buying. I'm also invested in copper, some copper players. There's another commodity that I'm actively buying, but because it's a very niche space, it can cause a lot of competition. So that will be something I would talk about with y'all in the future videos. I did a little bit of a talk on the psychology of investing and reflexivity on an audio podcast. I was just walking in, I thought I'd just talk out loud. So if you like what I'm talking about, that might be a great place to go to. Thank you for giving me the time of the day. Again, I'm not a professional YouTuber. I just come here to share my thoughts. So if you listen to it, if you found this useful, that's great. Thank you for giving me the time of your day. I appreciate you guys very much, and I wish you the best. Thank you.